I'm Dwayne Lappinga. Welcome to our webinar, Kick Ass in California, or if you want the more professional title, Succeeding in California Multifamily. We partly chose the fun title because even though we work way too much at TR Wealth, we also really enjoy living in the area. Most of you guys are probably familiar with this picture of Manhattan Beach on here, but this is only about 5 miles from our office. And of course, the fact that it's such a great location is part of the reason why we believe in California multifamily. We also, despite all the hard work, we occasionally get to enjoy closing some really exciting transactions, real estate transactions, which is, of course, the fun part. Housekeeping item, feel free to put any questions that you may have in chat, and we will answer them at the end of the session. If we don't get to yours, we will make sure and get back to you with an answer afterwards. So let me introduce myself real quickly. I got started in real estate. I'm a mechanical engineer, and I got started being a design engineer for commercial building systems, HVAC, plumbing, and fire protection. My next career step, I got licensed as a professional engineer, and then I got into energy conservation, energy management, and I worked for a 20 million square foot Southern California office REIT called Arden Realty. They brought me on to run their whole energy enhancement program, and that migrated into green buildings and sustainability. I became sustainability leader. And then we were acquired by GE Capital. GE Capital required much more in-depth financial modeling, and I discovered that I also had a real passion for real estate finance. Got interested in investing in apartment buildings, put some money with TR Wealth, and now I'm working here full time. I also made another stop. I worked in property management at CBRE for 7.5 years, which was also mostly office buildings. So I'll give you a little preview of what we're going to talk about. By the way, the picture on the left, the twin buildings with kind of the green area courtyard in between, is a 10-unit building in Redondo Beach that we acquired early this year. So we'll take you through what's going on with California multifamily right now. What are the challenges? Why are some people running away from it? And we'll discuss some key metrics of both the U.S. economy and then also what's going on with in particular, the California multifamily real estate landscape. And finally, based on all this setup, we'll give you what we believe is the way forward, how to invest in California multifamily and be successful while really minimizing the downside risk. So I want to introduce Bill Mulkey. Bill and I live in the same community. We first encountered each other years ago. Our kids were in preschool together, and then it was Little League and it was soccer. And then we found out that we both had a passion for saltwater fishing. So one of the first things we did together is we went deep sea fishing. Then Bill found out that I was interested in real estate investing, and I actually invested in a few of his deals. I started underwriting deals, and long story short, we're working together full time now. So Bill, why don't you take a few minutes and just introduce yourself and tell everyone, how did you get here? What was your journey?
Hey, thanks, Dwayne. That was really awesome. And I've seen like a lot of dynamic people that are joining in and listening in. I really appreciate it. I hope we can make this fruitful for you today. Just give you a quick background. Some people know me extremely well. Some may have just met me for the first time. I was basically a broker starting out at 25 years old. I'll try not to make this too long, but from 25 to 35, I worked at Marcus Millichap, very good training ground for multifamily and commercial real estate. I then worked another 10 years at Remax Commercial, focusing really on investment real estate with a balance 90% in multifamily. I just really learned a lot in the apartment market trade during those periods of time. I was quite young. I met just basically a lot of people that had their own different styles, and I tried to adapt them that I thought would work for me. I met a melting pot of people, from people just coming over, immigrants with no money in their pocket, to families that are uber rich and second, third generation wealthy, and anything in between. But I also learned I saw a lot of people that started from the ground up, kind of much like I did, and was very interested to say, hey, maybe if they can do it, I can. So I developed my own style, like I said, from many of the clients I worked with, and I sold some parties, one deal at a time, or some dozens of deals, and worked closely with some people, and really they did well. I even worked on some bank and institutional properties, where they represented the banks during the really hard times. Were in 1990, there was the savings and loan stopped lending, so it was a very hard time for everyone, including investors, and prices fell. I survived that market very well, and I learned my lesson. I learned, don't get overconfident, don't get over leveraged. And the expression I learned was, pigs get slaughtered. Don't be a pig. Learn and take it easy. Don't get overconfident. I guess what I want to say to everybody is, getting a mentor is great. I've had several of them, and you just need to reach out to people, because more people than are willing to help. I'm sure people on this video I've either helped or they've helped me one way or another. The bottom line is I got started, and I finally purchased my first property with only a $25,000 down payment. Not 25%, it was more leverage than that. It was in the year 2000. I took a long time before I got in, and at that time I was married to my grade school, high school sweetheart. So we've been married 27 years, and we still live in the same community, the one that Dwayne was talking about, local here to Torrance and Palos Verdes. And what I bought with a rent-controlled property. We're going to talk about rent control today for a minute. And basically, I was able to refinance that property 4 times during the ownership, pulling cash out of the property, and $1 million in maybe 10 or 12 years time. I was able to take out cash flowing during it and using it to buy other properties, supporting my business, whatever I needed to do with that cash. I didn't have to pay taxes on it. Additionally, there was another $1 million left in the property after I was done with it. Basically, it was a 16-year start to finish project. But just keep in mind, that sounds like a long time, and it is. But with $25,000, I got started. And it grew to another $2 million, because what I did is I used a 1031 exchange, and I invested in an 18-unit Lomita, and I bought 60% of that, deferred my taxes so I don't have to pay them, and I get cash flow every day from that on. I actually brought in partners to help me, because I needed more money to buy it and make it happen. And that's when I started really syndicating a lot. And that's syndicating basically is what we want to talk about today, and is bringing in other investors. So the thing I learned from my mentor was, a good investment lasts a lifetime. And he wasn't kidding, and I listened very well. That's what I learned from that. I took action, and I did something. So just what I want to impart to you guys today is that I simply love helping people invest in real estate in one form or another, or helping out. It's just more a decision to decide to do it. The $25,000 is a lot of money, but it's really not a lot of money in our space. But you can get started and take action and participate in either one of our deals or someone else's deals. You can pool your money together, and it's been a great asset for me. But one thing is, I start with the building I bought for myself first, because I test things before I bring it to my investors. So it's a tested, and it's a reliable thing, and it's stable, and I figure I can make money with it, and then I repeat success. So I don't bring you in for the first time just willy-nilly trying something. I've tried it myself first. I'm just going to give you a quick couple examples, and we'll get back to our slides and our conversations. But another example just recently that I have is that I purchased 5 units in Hawaiian Gardens. If you don't know where that is, that's great. I hope you don't, because the bottom line is, we search far and wide to find deals. It's not just our core market area, but we knew that was a good deal. It came up for only $239 a foot. It needed work. but the building was newer construction, like 1980s. I knew that every deal in the market was selling for $300 or more a foot. So I already had $70 a foot. It's a pretty large building for 5 units. I think it was over 5,000 square feet, over 1,000 square foot units. And so I knew we had profit. So what we did is we sent out letters to the tenants. 3 out of the 5 people vacated because they didn't want to have their rents increased or whatever happened there. And in 12 months' time, we actually doubled the rent. So 100% in 12 months' time. And there is rent control involved in this, California rent control going on. But people opted to leave or improve their lifestyle and move out, buy a property, whatever they need to do. Some people moved to another unit that we remodeled and paid the higher rent because they had never had any upgrades done for many, many years or even rent increases. So they knew they were coming. I guess the bottom line of this deal, which is the most amazing part that might sound kind of impossible, but in 12 months' time, we raised the rents, we refinanced the property, we pulled out money, and these investors, I offered them to buy 10% in our Redondo Beach deal that is overlooking Hollywood Riviera that we just bought in January of 2023 this year. And they were able to buy with that money 10% ownership in a property. And they go, wait a minute, I don't have to put out any money for that? No, you don't. And we didn't over leverage. We got a fixed rate loan before the interest rates went up. And now they're cash flowing for that investment, and they already own another property. When they got started, they didn't think they were going to own 2 properties right away, especially from Hawaiian Gardens to Redondo Beach. So where you start is never where you end. It's kind of like your life, right?
I thought I'd just show that picture one more time since you were talking about the building in Redondo Beach.
Thanks for that.
So let's move into some of the challenges of, why are people running away from California, Bill? Why do they say they want to invest in the Sun Belt or all these other places?
Yeah, well, first gotta be honest, market's changing right now. This is why we want to come out with this now. It's a really good time to buy, and we're going to explain why. There's a lot of challenges in our market. People are leaving California. Some investors are leaving California. That's some of our competition gone away, as far as I'm concerned. First thing on the agenda was the rent control that came in, and I call it California rent control. It's called 1482. Probably heard a lot about it. I'm just going to make some comments on it and not bore you for all the details. But the state, just recently put this into law, and basically it's the consumer price index plus, the inflation rate. So it says basically you can't have increases for more than 10% in any 12-month period of time or 1 year. And it's limited right now to 8.8%. But most of the models that we do anyway, we don't always project, more than 8 or 10% in rents going up a year, unless it's a value add, and then that's a different component we can talk about another time. But LA City is pretty widely known to be probably one of the strictest type of markets and not allowing unlawful evictions and raising of rents. They've actually paused them for a while, but that's all going away in February of 2024. So that'll be lifted, and I think things will get better there. And, some people are avoiding California, but to be honest, I'm kind of saying why. It's always been a stable neighborhood. We have basically more demand than supply. The new buildings coming on are just not competing with the rents that we have, the housing stock that we have that people need that's affordable in A and B locations. And I call it California gold. It's stable, it appreciates over time. And, historically, maybe 100 years back or more, properties in our area have doubled every 15 years. Our goal is to try to get it to every 10 years or less to make your money work harder for you. So California is unique, it's diverse. The higher prices here and the higher entry here, I think we've kind of taken care of that because we allow people to come in with very low amount of money to invest. So to have $500,000 or $1 million in our market is not a lot of money. But if I chunk it down and make it available to other people, then you can come in with $25,000, $50,000, and $100,000, and it may not change your life initially, but over time it does. It's just getting started again. Personally, like I said, I've made 2, 3, 5 times the amount of money that I've invested in over the years, and I've made it through the worst times in real estate way worse than anything that you're going to see on the horizon, I think. We'll get into that today too. And we just feel it's a much safer area, but we still make very, very attractive returns here, and properties appreciate well. So that's really what I want to say about California and why I like it. There's just a huge demand here.
So sometimes I feel like, people across the country are saying they only want to put money in the Sun Belt high growth areas where they say they can get huge rates of return, and they sort of lump all of Southern California as having this really brutal rent control and no evictions. And that's actually very specific to which city you're in. And for the kind of deals we do here, we're always looking for value add. And so to Bill's point, something in the range of an 8% rent increase is more than sufficient for us for doing rent increases when we want to actually completely renovate a unit, turn it over. And sometimes we're looking to raise rent in that process by as much as 50 to even 100%. The rent control is really not a factor. We have to work with the tenants to transition them out. For instance, the deal in Hawaiian Gardens that Bill was talking about, rent control had absolutely nothing to do with that. We simply approached the tenants. Several of them left voluntarily. They were paying somewhere in the $1,500 range, and now the new tenants are paying over $3,000 a month. So I'm going to go ahead and talk a little bit about the economy, kind of the landscape, because we want to do value add deals, but what are the basic parameters we're dealing with? We still have to deal with interest rates, which direction the economy is going, et cetera. So this is probably the part of the PowerPoint that you were really dreading, where the finance guy talks about charts, pie charts and everything. When I was at CBRE, we used to joke around that it was death by PowerPoint, because we'd have to watch like 10 or 12 of these in one day. And once we got to the afternoon, everyone was just screaming, go faster, go faster. So I will just hit the high points. So US economy in general, we'll show you some charts that indicate we will have economic growth going forward, pretty steady economic growth. It's probably going to be like 2% annual GDP increase, not the big numbers we saw coming out of COVID. And historically, California has had a little bit stronger growth than that. And I think that's the incredible economy we have. Interest rates, we'll show you a chart on that as well. It's really looking like despite any speculation that anybody might have, the Fed is either done or close to done raising rates. And they may have actually succeeded in finally turning inflation the other way. California has really strong employment, and it's kind of right in the middle as far as wage growth. It's not the highest, it's not the lowest. The vacancy in the Southern California area, apartment vacancy, is actually lower than the nation, which is a testament to our lack of supply and just how there's constant demand here for housing. Going forward, average rent growth is going to be a little bit less than the U.S. For our value add deals, we actually don't really care, because we're just looking for buildings that, we find buildings that have rents 30, 40, 50% plus below market. So what we're after is a stable environment to do a value add plan. So let's go through some of these charts. So I feel like this one tells a really interesting story on GDP growth. So in some ways, the whole story is all about COVID. I mean, that's an oversimplification, but I mean, just the unbelievable decline in GDP during the lockdown, and then almost a violent rebound from it. And then we see much higher than our usual growth for the year after 2021. It's almost like we kind of got carried away. Some of that is, low interest rates. People were given money in various government subsidies, so they had money on hand to spend. And then what nobody talks about is we actually had a little bit of technically 2 quarters of negative GDP growth is a recession. by definition. So in 2022, we already had a little bit of a recession, but nobody talked about it. Everybody just said, a big one's coming, a big one's coming. So then you all know the story. We got Ukraine, we had a bank failure, which was really because they were counting on continued low interest rates. And then, of course, we got hit with inflation. So the Fed starts raising interest rates, and we still have economic growth. It's just not as extreme as 2021. And this particular chart, I look at this almost every week. For the last 2 years, I've looked at it every week, and it kind of amuses me that this slowdown here that's being predicted, they've moved this back 3 or 4 times. At first, this was supposed to be the beginning of this year, then it was the middle. Q2 came in higher than expected. So I'm almost wondering, as much as the Fed drives us crazy, I mean, they're killing me with the effect on my home equity line of credit, for instance. So it is painful, but it seems like their target of a soft landing for the economy may actually come true. So this is the latest prediction that we resume with about 2% GDP growth. But I wonder if this may never happen. But the bigger point is, for something like any type of investing, here we're talking about real estate investing, if you wait around to see when this happens, you might never put money in the market. And we believe that the buying opportunities are coming right now, actually. So a little bit about interest rates. So I put the figures in big numbers here because I can't read this chart unless it's on a really big screen. But this is the consensus of all the Federal Open Market Committee members of where rates are going to be. So we're looking at, we're topped out now on the Fed at 5.5%. Maybe it goes to 5.75. I don't know. But next year we're 4.5%, then 3.5%, stabilizing at 3%. So I don't think that 0% interest rates are coming back, which that means probably our 3% mortgages are coming back, which, it'd be nice. But the point is, we're looking at a stable environment going forward. Of course, these aren't directly correlated to mortgage rates, but they certainly have a big influence. Once again, in some ways, the story is all about COVID. This is a chart from CoStar on rent growth. So the orange is percentage rent increases, and you see because people weren't able to rent units during COVID, it actually shows up at a negative, and then kind of this run on apartments. I mean, there was a time we were leasing units in a week, in days, and it's almost like we got overheated and interest rates went up, and so now we're kind of normalizing here. And it looks like prediction is kind of steady 3% rent growth in the Southern California area going forward. This chart also really shows the premium of living in Southern California. Just, here's dollar rent in LA, and here the yellow line is dollar rents for the US. There's a premium to live here, and people are always going to pay it. There might be some people that are leaving the state just because they think it's too expensive, but our argument would be that those that have the quality jobs, et cetera, are always going to want to live here. Okay, final painful graph to look at. The main thing here is showing that the vacancy in the green line is predicted to taper off. And, it's all kind of getting back to normal after COVID. These blue lines are supply coming online, and you can see we actually kind of got overheated, overbuilt. But as we go forward, we're seeing absorption is greater. The orange lines are greater than what's being built. The Fed shows how what the Fed does actually does have an impact. They raise interest rates and people slow down on development. But another interesting thing is places where we typically buy buildings, like in Torrance, there's actually almost no development because there's no land left. So we see development in outlying areas, or we see kind of high-rise luxury that we don't really compete with. So that's our landscape of the economy. That's why we believe that you shouldn't try to time the market. You should just look at, are your basic fundamentals reasonable? We're looking for stability, and then it's all about finding those value add deals. And on that note, I'll turn this back over to Bill for how we actually execute on our find deals and execute our plans.
Hey, thanks a lot, Dwayne. Thanks for hanging in there with us, guys. I think that's really good information when you can interpret it, and when you live it every day, it makes sense to us, and we're here to interpret it for anyone who needs some more background. But we could talk forever on every single subject. Basically, the making regulations work in your favor is just basically know how to play the game. It's like checkers and chess. If you do it and you play it a lot, you read the rules, there's the laws, and then there's the way they're interpreted and enforced. And there's tenant behavior, and there's just everything to deal with, A to Z. I think it's still possible to evict tenants, the bad apples. I still think that many of the tenants you can work with. They're human beings. They're our clients, actually. We have our investors, but then on the other side we have our clients, which are also our clients, is our tenants. And I've just learned to really treat them right, because they stay and pay, and even in the hard times they stay and pay, and those are good things. Those are really good things, because I've seen people lose money by not treating their tenants right, and I learned that in the 1990s and onward. Every day I learned my lesson. So many tenants will voluntarily work with you. They'll move to another unit. They'll let you increase rent for barter, for free space on their property, or a pet deposit, or remodeling, or giving them carpet that they haven't had from the prior landlord. All kinds of things that we do to improve their lifestyle, and they stay and pay, and they're happy. Again, just reviewing rent control. Getting 8% or 10% or 5% is a pretty good rent increase when you are using some of the bank's money. And if you buy things right, in 5 or 10 years, you're at 50% at 5% a year. So you get it one way or another. It's just how fast you do it. I think basically what you need to know is that we have our own management company, and trying to do it yourself is great, but you might lose your mind doing it, and all your time you will lose. So if you have another job, whether it's even real estate related, and you try to do your own management, I have a team of people here, and to be honest, it still consumes a lot of our time. It's always the urgent thing in the room, and it can really distract you. So I have a staff that's really well trained. They came from different management companies and different people, but we all think the same, in that our clients are our tenants, and we don't just boot people out. We're just not like that. I'm a human being. I don't want to be known as that. I think you also have to be really confident in your underwriting. We have so many people that we have inspectors, we have the bank appraiser, we have the bank itself. We have so many different loan brokers. We have real estate brokers, both the buying broker, selling broker. We have Dwayne, who functions as an asset manager and CFO of the firm. We've got his analysis and my analysis. We probably do 30 or 40 versions of a property when we buy it, tweaking it every time we get more information to try to mitigate anything that we've missed. But we still get cold feet, even as we buy or even as we close. And we wonder, oh, did we do the right thing? You paid the highest cost per unit in the market. Well, guess what? That was probably the best deal I ever bought, because I knew I had other factors that were coming into it, and I knew what I could do with it. Because being a broker a little bit, I know what buyers and sellers want to pay. I also know what renters want to pay, and what they're looking for from our management side. So having a professional management company in the same company is vertically integrated, and we're able to communicate very easily. And we've done it over 70 different syndication transactions that we've done. So it's not our first one. It's not our first rodeo. So I think California is a slam dunk. That's why I named this thing Kick-Ass, because I really feel that you can, just by getting involved and making commitment and buying. Again, it doesn't take a lot of money. It does if you go it by yourself. And I tried that. It's hard. And we are family here. We invite people in to join us. We have a lot of different types of relationships with people, from insurance all the way down to our vendors, everything, even our tenants. And I think outside making a really bad decision, ill-timed or ill-advised, over leveraging, and like I said, managing yourself, thinking, go out and buy a different product you never bought in a totally different area you don't know, not using the mentors that you have or the guidance that you get. It's just if you don't do all those things, it's a no-brainer, and you're going to come out a winner. So I don't know if I answered everything on this slide, but I just came from my heart with that, and I just really want everyone to participate because it's just been such a good vehicle for me. And a forced savings matter. I put money in and I forget about it, and it grows exponentially. One other thing that we want to mention, I guess, at the end is at the bottom of the slide, it says that we're going to be launching a multifamily fund. So that means you can buy one of several properties with us that will be rolling out for sure by the end of this year, maybe a little bit beforehand. And it'll be a value-added fund, so you can participate and invest with us, and we can get more into the details later. But I'll turn it back to you, Dwayne, and maybe some questions and answers or something like that, if we have that time.
Yeah, I mean, I guess our point is we would love to help you meet your investing goals. If you want to be a passive investor in our upcoming fund, we believe that the timing for buying is going to be outstanding because we are seeing some softening in prices, and everybody seems to be waiting for, when is this recession going to happen? And we're not going to wait around. We're actually going to start looking for the good buys right now. And it seems like the market is moving down a bit right now, and everybody's kind of waiting for that to happen. And we're expecting, over the next 12 to 18 months, to see lots of good deals available. In some ways, that really hot market in 2021, everybody was buying anything over asking, and we had a very difficult time finding deals that made sense on paper. I guess that's the story of our underwriting, that we have a feeling about stuff, we have buildings that we want. We always go back to the discipline of underwriting it, and does it really make sense? Are the rents that would be necessary, are they realistic? Can the deal be reasonably financed with some kind of margin of safety? So that sort of keeps us on the road, even though Bill always tells me he did the financial model, quote unquote, for his first couple syndication deals on one 8.5 by 11 piece of paper and a hand calculator. And obviously, he was telling you he made like over 1,000% return. The gut is pretty good on most of these things, but we definitely still go to the steps of doing pretty in-depth rent comps and sales comps, and now we have in-house professional management to make sure that we actually deliver on our projections. But if you want to participate in the market in any other way, if you need somebody to help you with your property management or brokerage needs, or if you want to start your own operation and you just want to pick our brain, reach out to us. We're not here just to say, hey, join our fund, or otherwise, we don't want to talk. We continue to really believe in this market. It's given so much to us and our investors over the years. It's helped Bill out. The investments I made were, life-changing for me. And so that's why we're a big believer in it. You guys are shy. I don't think we have any.
There aren't any questions, but I would say that if we want to open it up, if people want to ask questions, if they want to unmute themselves, or they can raise their hand too, we can take those as well.
Either we were really, really good and made everything crystal clear, or we were so boring that everybody's just like, I think I'm going to click off pretty quick.
Dwayne, This is Sam Okuda. Thank you for Bill. Also, good presentations. We are in asset management, property management business. I've been doing almost 2 decades plus, especially the challenge after we got hit by COVID. A lot of activities against landlording, eviction moratorium, rent control, we still keep going on. I think this year will be a little bit better control the market and the tenants, but the tenants to take full responsibility. My question is, forthcoming 2023, we have a remaining 6 months and 24. What is the most challenge as asset manager to keep a good cash flow? Was it because of the tenant issue? I know you mentioned about some the government new ordinance may apply for. What is the most challenges? And also, when I get into business, real estate always location, locations. So not all the property in terms of multifamily hit hard. We have a good location. We still have a good room to grow in terms of cash flow. So what do you think?
Hey, Bill, do you have an answer? If
Yeah,
not,
I've got lots of answers.
Yeah,
they don't
summarize.
they all don't hit exactly at home maybe, but the first thing is it depends on your interest rate, right? You got a cap rate that's in there that's if you buy cash, if you buy a building cash, the internal rate of return is kind of like your cash flow and your cap rate. So for give an example, you buy $1 million property and you have a 5% cap rate, you're going to be making, $50,000 a year cash flow because you have no payment. It'd just be the vacancy and the collection loss and all that stuff, less your expenses is your net operating income. There's no loan on an all cash deal. It's just easier to explain that. So that means the investor, if they pay a 5% cap rate or a seller sells for a 5% cap rate, that means that the investor is accepting a 5% return on $1 million.
Mm-hmm.
So, we can talk about a 4 cap rate, we can talk about a 6 cap rate, we can talk about an 8 cap rate. It's just the amount of return that someone's willing to do. As a broker, 25, 30 years of a broker, something's worth what someone's going to pay for it. Right now, I feel that there's not a lot of buyers transacting. So I think values have fallen a lot, not because they should, but because they just are. Because if you want to sell something, at the end of the day, it's worth what somebody wants to pay. So real estate's a little slow. It's slow to react. But that's why I like it, because it's predictable for a while. It's not like the stock market that it's so well informed that when you say something, everybody overreacts or already reacted before you even get a chance to react. So I like real estate's a little bit more slow and predictable. And I know it's probably going to fall for a little while. But the problem is people try to time it. And I think that's where they make a mistake. They wait for the perfect timing and they always miss the bottom and when they buy, and they always miss the top when they sell. So interest rates. If you have a very high interest rate right now and your cap rate is very low, then you're probably going to be losing money, especially if you took out a lot of loan or a lot of leverage compared to the value. So it just depends on what your interest rate is, how long it's fixed for, because there's 3, 5, 7, and 10-year fixed, typically in 5 or more units in multifamily. So that's the number one thing is where are you at? So I always take somebody's property and somebody's strategy and learn first what they want to do with that asset, right? Location is very important. I call this the closer you are to the beach, the water comes in, it keeps going further and further and further all the way out to the east side of our counties. And then it recedes and it leaves you there. So it's always best to buy the best areas. However, I'm talking about a product, which would be like, say, right on the water or something like that, or a product, a building would be a newer building. We're finding that we have a lot less competition in our B markets. And I know, Sam, that we've talked about this before personally. You've done better in the B markets because I had properties in Redondo Beach Prime, 1 or 2 blocks away from the water, and I saw my rents erode as more of a percentage of rent than they did in Inglewood or Hawthorne or Gardena or Bell Gardens or Downey, because they just had less room to fall. So it's not always A+ areas that are just perfect for everyone, because for those areas, they've been typically 2, 3, and 4% cap rates if you're lucky. So that means they're accepting a much lower rate of return. And that's okay for people that have a lot of dough, but it's very hard for people that are trying to have a investment on the side of their day job. For the pros that are doing every day, that's different thing. They're well capitalized, they have a lot of money. But if they're big people, they can weather those storms. But I speak mostly to the people that are trying to invest to get their return more. So in my experience, I've done very well in both the A and B areas. Don't over leverage, like I said before. And interest rates are here right now. They're much higher than cap rates. And that's why investors are hesitating. The longer they hesitate, the more people I'm going through to find the motivated buyer in the stack. Most people aren't that motivated right now because they don't want to come to the real price. So they have to wait. And I have to find the motivated buyers from the people that aren't motivated. So I hope I answered some of those, Sam. I'm not sure I hit it exactly right.
Thank you, Bill. Thank you, Duane.
Thank you. Also, if I can add anything, if anyone doesn't have anything, I just add to it, when you buy a stock, it goes up and down in value, right? And it sometimes goes quickly. It fluctuates. Real estate's a little bit more predictable. It doesn't just slam down or up so fast, but you can actually control your real estate. You can actually improve your real estate. You can back off of certain things. You can add on certain things to improve it. You can finance it. There's all kinds of tax advantages that a lot of people in this seminar know about. And so whatever return we say, there's usually more after taxes. So there's a lot of advantages in depreciation, mortgage interest, and all kinds of write-offs for doing capital expense items, so which add value to the property. So that'll help you.
Hey guys, Daniel Shea here. How's it going, Bill, Duane, and Sam?
Hey Daniel, thanks a lot for participating. Daniel's a super broker, and we worked with him a lot in the past. He brings good inventory. Hey Daniel, how you doing, man? Doing
well. Thanks for having me on. Quick questions about your upcoming investment. Like what area? I know you mentioned Hawaiian Gardens. I assume that's already closed.
Yeah, that was a closed deal. Yeah.
What are you looking, or where are you looking right now, and what's minimum investment?
So the area is going to be a focus on the South Bay, the markets that we're real experts in, like Torrance and Inglewood, Hawthorne. If we could find those great values, even like Redondo Beach, we're hoping maybe a few people want to unload buildings there at a reasonable price during this time period, but usually they're just overpriced. And honestly, we're probably going to avoid the municipalities with the really severe rent control and that have had the eviction moratoriums, because the not being able to evict a really bad tenant is just proven to be a killer to a deal. I mean, let's say you have like a 6-unit building and you have a tenant that doesn't pay rent for a year, you can't do anything about it. So we want to avoid that. As far as minimum investment, we're looking at $50,000 per limited partner. And if that proves to be an issue, we would certainly talk about it.
It would be value. It would also be value added too, right? Because properties that are marketed very well with a very attractive return usually get purchased, or competition, then get bid up. We also are doing a lot of off-market direct from an owner that says they might want to sell or have a special problem that they need solved, or they need time to find an up leg. So we come in and we're very patient with our money. We're waiting. It's good for us to take more time. We raise the money from our investors and we prepare and learn more about the property. Oftentimes, Daniel, especially in an increasing market, we've actually optioned money to buy a property, and the seller takes a long time getting their records, and their act together or to find a property. And we've seen the value for $50,000 deposit. We've seen it go up, you know, $100,000 in value. So we made money before we even bought it. And or somebody vacates and we ask the, you know that I've done that with you. We've asked the broker, hey, hang on, don't do anything with that. Let us improve it, put the money in it, and we'll get even more than the owner can for the building. So we've done a lot of that with you and other people, and it's really worked. And I think it takes a lot of time what we do. We take a lot of time with the broker, we take a lot of time with the tenant, we take a lot of time with the investor, and we just marry it all up. And it just takes a lot of touches, a lot of time and care. But do you have any other questions, Daniel, or was that more specific to you?
Do you guys cost seg your buildings?
Yeah, we do some of that too. That's a great question. We're going to probably have another talk on that later on. But basically, he's talking about component depreciation, which is available. It's just an option that you actually, I've done it a lot. I probably did it on 10 buildings, and our investors saved $1 million in taxes, just to let you know it works. And I have people that do it. I can give them their phone number and I can attest to it. But basically, not everyone is, the active investors like myself and you, Daniel, a broker, can take a little bit more advantages of it than maybe a passive investor, but they still can take advantages. And if they have any other property, they can write off. Let's say they have a building that's already repositioned and doing really well, strong, they've owned for many years, and they're making a lot of money, and they don't want to sell it, right? A lot of guys are like that. They just want to keep the one that's working. We come along, they invest with us, and we give them negative, we don't lose money. We lose money on paper. We give them write-offs, even though we're making money on cash flow, and they're able to use that against their other investments. So it's like kind, and they're able to do that. But there's limitations, but they still are, after taxes, more beneficial than other investments.
Question. Hey, Bill, thanks for inviting me on the call. Dwayne, good to meet you. Great presentation. It's like a general rule of thumb. How much debt do you normally put on an investment?
That's a great question. In the A areas, we're probably putting no more than 50% debt required by the lender, by the way, even though we know we have a stronger outcome. And then probably max 70% on other areas that allow for a higher debt coverage ratio. In this market, things are different. Interest rates are higher. Banks are more concerned. So even more reason why you invest in a syndicator like me or us or another one, because they have other people's funds that they're pooling together like crowdfunding. So they're able to put more down and buy maybe a few more units to spread risk and cost per unit and stuff like that and get economies of scale. So that's another reason why we're scaling it, is because with more money on hand for reserves, you can battle the perfect storm that could come up. You could switch strategy slightly. I don't like to say switch strategy, but you want to be very flexible, right? You don't want to always you always have to have an exit plan when you buy a property. It's not just, I'm going to sell it for more. I'm going to hold it for cash flow. I have 2 or 3 outs and exits whenever I buy a piece of property, because I've done it, from the beginning, and I've learned, oh, wow, I'm locked into this loan. Now what am I going to do, or whatever? So I've learned from myself and from my clients that I've served how they've locked themselves out. But I can tell you this, the people that don't take action pretty much never do, and they don't get invested. And I tell you, you're a financial guy. You know that just getting invested and putting it in and holding on to the stock versus buying, selling, and going crazy and paying all the fees to do that is probably a good approach, right?
Yes, yeah. It's the hard part is jumping in and doing the first one and then seeing how it works. And then one more question. There's probably a ton of questions, but in terms of once you buy a property, do you require additional investment ongoing for there's maintenance, deferred maintenance or unforeseen maintenance, or do you have a reserve set aside already when you purchase the property?
You're actually talking about capital calls. So we avoid capital calls like a plague. Actually, we've never had one. And, in our underwriting, we allocate a certain amount for reserves for the unexpected, and also for how many units we think we're going to have to rehab. So that we can't say 0% chance of a capital call, but we're trying to make it extremely unlikely. Just not fun for anybody. I mean, investors, they make an investment and they decide to make that decision to come back to them and ask for 5-10% more money later is just, nobody's happy in that situation.
That's great. Thank you.
If I may add one thing to it, because we're about to go over our time, and we'll have other questions and other events like this that we can ask, and we're always open to our contact information. We're always open to other questions. They're great questions. When we buy a piece of property, or let's say when you buy a piece of property by yourself, you have to come up with the whole down payment plus closing costs, right? And most people, that's like all they can get over the edge to buy something. And where I think that's a big mistake is, it's an investment property. Once you buy it, then you invest in it. People think investing is just buying it. No. You have to buy it, and then you have to have, where's your plan? How long are you going to keep it, right? Just like a stock. How long are you going to keep it? When are we going to sell it? You have to have a plan. And most people just get into it. And by the way, 80% of those people do well because they buy and hold for a long time. They'll be fine. What we do better is we buy it. We have additional money from all the partners on the side because I don't have to come up with all the money myself, right? I have other partners that come in. So they're more apt to have more money at the end. And by the way, it makes underwriting harder because we look at all the money we put in, all the money we get out to establish our return. Most investors just get in with that $500,000, barely. And then when a tenant vacates, the tenant won't vacate because they don't enforce the rules because they're too far. They don't have enough money to put in for capital improvements and take 2 months for vacancy and find a contractor to improve it and then shop at Home Depot. They're done. We have all that done. So we have a plan and the money in mind to handle the investment. And by the way, worst case scenario, if hell breaks loose, we still have all that money and we don't put it into the property. We hold it in case there's a major catastrophe, right? We still have that. So we have a year or two of income and expenses to cover a loss if it was a major, hurricane or whatever. So I think that's it. But again, it makes it harder for us to underwrite a deal because we're looking at it different than the normal investor. So it requires us to buy it at a better price and better terms.
Yeah. Besides just the plain money part about it, I think an advantage of participating as a passive investor where you have a operator that's their full-time job, that's all they do. The operator, which in this case would be us, they get to tear their hair out and stress about these things. And, you don't really have the burden of that responsibility of, what if suddenly the property needs a new roof a year after I bought it and I didn't think it did. I mean, that's, as a passive investor, that's not really your burden. That's something that, we have to manage.
Probably going to wrap it up now, I think, because we've gone our hour worth of time. Thank you for spending it with us. If you guys want to connect with us afterwards, call, email, whatever you need to do, we're here to service. And we'd like you to invite somebody else to come in the next time we provide this. You'll be on our mail list. We weren't going to bombard you. We're just going to inform you of what we're doing and what opportunities we have coming. And again, my wish is just that everyone invest in real estate for what they can afford to invest and watch it grow. It's a great vehicle. I don't know a better one.
Thank you very much, everyone, for joining us. Really appreciate it.
Thank you.
Thank you, guys. Talk to you soon.